raised almost 139 crore rupees in venture debt. At a time when you're hearing so much about equity fundraisers that have led to unicorns in the last couple of weeks, even during a pandemic, a lot of buzz around pre-IPO placements, so many startups talking and dreaming about large IPOs, we started thinking, why is BharatPe looking at the debt option? Another startup, Furlenco, which is in the business of online furniture rentals, has also gone in for the debt placement of about 44 crore rupees. Joining me to talk about this is BharatPe's co-founder, Ashni Grover. Ashni, thanks so much for joining us here on Startup Central. Wishing you and the entire team a very happy new year. You're beginning the new year with one of the largest debt raises that we've seen by a startup. 139 crore rupees. It's not the first time you've gone in for the debt option. Can you tell me why you chose the debt route over any other route?
Yeah. Thanks, Nayantara. Thanks for having us, and a very happy new year to you and the team. Nayantara, our business, if you look at it, at the core is a lending business. What we do is help merchants accept payments, and on back of that payment transaction data, we lend to the merchants. So increasingly, our lending business is becoming bigger and bigger. And for all lending businesses, the business cannot be funded by equity, right? All good lending businesses have a good ratio of debt to equity, where the debt component is normally much larger than the equity component. So if I look at our business, we have so far raised $142 million of equity. We've only utilized 62 million. So we still have 80 million equity in the bank. So what we are now starting is the next phase of journey for BharatPe, where incremental capital, especially towards lending, will primarily be debt, and it will be many times over than the equity that we raise. So for us, it's a graduation from boys to men in some ways. For me, the debt raise is so much more exciting because it's a validation of the core business being profitable.
But if you've got $80 million of equity already, why do you need more funds? Why do you need to even look at any other option?
Sure. So, Neta, what we have built so far is what people see. What we see is what we have to build from here on in the next 2 years. And what we have to build from here on in the next 2 years is order of magnitude larger than what we have already achieved. So it is imperative that now that we are starting on that journey to really build the business out to a different level over the next 2 years, we should be well funded upfront for it, right? So what you see is just the start or the first tranche of debt come. What I want to build over the next 2 years is actually a 5,000 crores AUM business. Now, if you look at any business which has 5,000 crores of book, roughly 1,000 crores of it would come from equity, and 4,000 crores should come through debt. So that is the scale at which we want to operate. So it's just the start. You will hear a lot more of debt raise happening at our end in the coming months.
You know, Ashni, one of the reasons I wanted to do this segment with you on Startup Central was also to get an insight into this entire, we have spotted a trend, right, of startups announcing the debt option over the equity option. I know about the old economy, but for startups, for the new economy, when the track record may not exist, when the failure rate is also so much higher, can you share with us a little bit about the ecosystem that exists for lending debt? How robust is it in the first place?
Yeah, you're absolutely right. See, startups are seen as red balance sheets by your traditional lenders, right? So whether it is banks or traditional NBFCs, they normally shy away from lending to you. So the first port of call, especially if you want to borrow debt capital, is to go down the venture debt route. And that's what we have done. We've already announced 2 tranches, one coming from Innoven and the other one coming from Altiria. And there's a third one under the works. So very clearly, anyone who wants to start on their debt journey today, there are 4 and 5 ports of call, and all of them are in the venture debt. But my fundamental belief is this is going to change drastically over the next 2 to 3 years, where even in startups, the core business and the core profitability is now coming and getting crystallized. So a lot more people like me who don't necessarily want to dilute their equity get very attracted to debt as an option. And therefore, there is a big demand which is getting created in the ecosystem. I speak with a lot of fintech founders, and they're very, very clear if debt is available, equity is the last option they want to go towards. And I think eventually this demand will create a different market altogether of capital, which will be primarily debt, especially for fintechs which are in the lending business.
So the demand is being created. So I'm guessing now you're also seeing those looking to meet that demand. You know, you've gone to the firms that you mentioned. There's others like Black Soil, etc. You've seen IndiFi try to do this also with Tide Delhi. But Ashni, tell me one thing. Obviously, equity is your most valuable asset as well, right? It's also ESOPs and all of that is the currency on Startup Street. But if I were to look at the sheer cost, the cost of capital, equity versus debt, how different is it for the startup universe?
Yes, it's a function of how do you treat equity, right? A lot of folks treat equity as zero cost, right? That's not how I look at it. For me, dilution of your ownership in the company is the highest cost that one has to bear to run the business. So even if you look at from a capital market perspective, the returns the VCs are expecting from the investments are 25-30% IRR on the lower side. They actually want to make multiple times return on the money invested in you. So for clearly, equity is much more expensive than debt. The thing is, can you raise debt, right? Do you have the ability to raise debt? If anyone in today's market has the ability to raise debt, even at a 14, 15, 16% cost, it is much cheaper than equity.
So you're saying debt at 14 to 15% is still cheaper than equity. So Ashni, just doing another reality check of sorts for our viewers here. Those who give you money for equity, the venture capitalists, the private equity firms, all of them, are they still looking at a minimum return of 20 to 25%?
Absolutely, Nayantara. So the minimum, and I'm talking absolutely on the lower side. Below that, even the VC funds will find themselves to difficult to raise money. Is 25%. Good VC firms, basis what investments they make, actually end up making much higher, close to 50 to 60% IRR for themselves. So, and all that IRR is eventually the company has to pay, right? And it takes the form of a dilution. So it doesn't appear as a direct cost to you, but if you actually do the maths, even at a 14% or a 12% cost of debt, the debt can work out almost to 1/3 the cost of equity. But you should have that ability and a robust business to raise the debt in the first place.
Ashni, I'm getting you here on the channel to do a masterclass of sort on venture debt and why a startup, a fast-growing startup like BharatPe is looking at it. You said the first port of call has to be to the venture debt funds. Which are the larger ones? You're saying there's a rising demand. So are you also seeing maybe traditional banks, like you've done a deal with ICICI? Are they all now looking at this new space, coming out with new products?
Absolutely. So if I talk about venture debt, there are the usual names. There is Innoven, there's Altiria, there's Trifecta. These are the three large names, at least that I know of. If I talk about banks, even in banks, they now are budgeting a certain part of the loan book, which has to come from the new age businesses or startups, as we call them. And there is a willingness to take some small exposure at all banks, right? So I think as I pointed out earlier in the conversation, the market is getting created slowly but gradually.
Okay, the market is getting created. There is a demand that is out there. Typically, for a startup to go in for venture debt, how much is it more than, let's say, the prime lending rate?
So it again is a function of what your business is and who the lender is. Banks obviously have a lower cost of capital and therefore they can always lend to you much cheaper. For us, the ICICI Bank tranche has actually come at a cost of sub 9%, which is a first for startup industry. At least I'm not aware of any other startup which has raised debt at such low cost. Traditional venture debt again can vary. It can be anywhere between 12 to 13 to on the lower side to 16 to 18% on the higher side. But again, it's a function of how credible your business is and how de-risked the business is. The more de-risked the business, you're going to land up at the 12 to 13% cost.
Now, I want to talk to you about your next phase of growth. You hinted that in your first answer, Ashneer. I was talking to you in January 2021. What's the plan for this year? 2020 was, of course, tumultuous, but it helped a lot of the merchants that you do business with to go out there, accelerate, digitize, all of that. So what's the game plan for this year?
Yeah, so Nandara, we have a 2-year plan now. We would be closing 2021, fiscal 2021, at almost $8 billion annualized TPV. We want to grow this three and a half times to almost close to $30 billion, 30 billion US dollars of annualized TPV, which will become the payment side of our business. What we want to do in parallel is grow our loan book many times over. So our loan book today would be close to 400 crore rupees. We want to increase this loan book to almost 5,000 crore rupees by March 23.
Okay, and as far as the target, I mean, you don't have to share the targets and all with me, but it's also becoming a very competitive space, right? Where you're at, whether it is from a Geo or from a Pine Labs and all of that. So you do have a first mover advantage of sorts, but how will you maintain it and grow?
Yes, we've always respected competition, but really never feared them, right? To me, it is very clear. Your product proposition has to be so strong that the customer goes for it. And even in today's market, if you look at what BharatPe brings to the merchant, is much superior to any of our competition. And the what we have done so far is maintain that discipline in getting the right products out in front of the merchant. Do not go for jazz or just fluffy numbers. We actually go to the core of what the demand in the market is, which to me is capital. So we have doubled down on the fact that lending is the real business, and we are doing lending much ahead of any of our competition. And hopefully, over time, this head run that we have should only compound and give us more competitive advantage.
Okay, now you talk about lending. You've been talking a lot about lending during this interview. I want to ask you one thing, Ashneer, that is with the Reserve Bank of India also now red flagging how debt is being recovered, a working group that is being, being set up to look into this. On the flip side, as all of you grow and you don't have the infrastructure of a lot of banks that had all these ballooning NPAs, how can we ensure that that problem doesn't turn up in this space as well? That, this fintech doesn't become the new hotbed for NPAs?
I think on that, the principles are very simple. In any lending business, the key is collection, right? Collection and underwriting. Those two fundamentals do not change whether the business is being done by a traditional bank or NBFC or whether it's being done by a fintech. So as long as the fintech does not lose sight of that fact, I think all NPAs and the quality of book can be maintained. If fintech start running lending businesses like payment businesses where growth is the only thing and they don't look at the quality of the book and the profitability of the book, then of course it's going to lead to a big ballooning. For us, it's a right mixture where we are aggressive in the growth that we want to go after, but we never lose sight that it's a lending business. It's all about saying no and your ability to say no to business.
Okay, but then, you might have the ability to say no or the gumption to say no. The problem then becomes if the ecosystem is not, if all the players are not behaving as responsibly. Before I let you go, Ashneer, my final question to you, you've also seen tremendous success with Bharat Swipe. What was 2020 like for you as far as growth goes? And are you looking at new segments as well for the new year?
Absolutely. So Bharat Swipe has actually been the star product for us in 2020. We've already acquired close to 50,000 merchants on the swipe machines. Our annualized TPV is almost touching 1.5 billion US dollars. So it's a great start. The product has actually seen the kind of start we saw with our QR product in the initial days. Going ahead, I am personally very excited about the distributor side of business. So we are building another layer between the retailers and wholesalers, which is going to be primarily driven by credit. And that is the next big thing that we're going to work on.
And when will all of this be rolling out, etc.?
So distributor to retailer, the product is ready. The market is the team is working on the go-to-market strategy, and I think you should see some sizable developments happening from our end in next 2 to 3 months.
And with that, Ashleen, I'd like to thank you for taking the time out to join us here on Startup Central. Here's wishing you all the very best, and thank you so much for being so patient and holding this masterclass on venture debt.
Thanks, Nindara.